All right, all right, all right. Good morning, good morning. How are you guys today? Bright and early, first thing in the morning on a Friday morning. We're up and early. You know what? The sun used to get up before me, not anymore. Now we're up before the sunshine, ready to trade, ready to make some money, ready to watch these markets. Excited, right? Excited on a Friday morning. You know what? I think Bruce deserves an award. Bruce, you deserve an award. You are here every morning. You know who I've missed? You know who's not been coming lately is Michael Bruce. I haven't seen Michael Bruce in a little while. Maybe he'll show up today. There's Edgar. Edgar, how you doing? It's good morning. It's great to see you guys. Uh, we are getting started here first thing in the morning as we watch the morning bell. And then we're going to run over and we're going to look at the stock market, and we're going to be looking at the seasonal nature of markets. I kind of wanted to trade with options today, but we got to do the seasonal nature of markets. We haven't done that in a little while, so we're going to day trade with options on Monday. So we'll look forward to that. But today we're going to do the seasonal nature of markets, and we're going to look at the seasonal trends, and we're going to look at the stock market and see how things are doing. We're going to review our stock portfolio and see if there's not any adjustments that need to be made. I made a few adjustments yesterday, so I cleaned out a few stocks, put in some new ones, did a little bit of cleanup on our portfolio for today's class, but we're going to go through and review those trades, and then we'll get done with that. So let's go through and see what the Fed's doing today. See what the Fed is doing. Is the Fed up to anything? Yep. Today, Goolsby gets to speak today at 7:45. So in 15 minutes, Fed Goolsby on a Halloween Friday morning gets to speak. All right, so 6:30 this morning, we had PPI, which came in at the forecast was 0.1. Previous, they haven't posted those numbers yet. No actual. You know what I thought was interesting? You tell me. I don't know. I'm just a guy that sits here on YouTube. But I thought it was very interesting how last week we had record-breaking numbers. Oh my gosh, record-breaking employment. How does this work? Record-breaking employment. Oh my gosh, things are so great. Everybody who wants a job has a job. There's nobody left to fill all the jobs. And then this week, we had a report that came out that said, oh my gosh, there's more people applying for unemployment than we've ever had before. I don't get it. I don't get how those numbers jive. How can you have, oh, it's the greatest in the world, no jobs left for anybody? We've got everybody, the whole world's employed. And then the very next week, it comes out with a report that says, we got more people asking for money that says that they don't have jobs than ever before. If somebody can explain to me how that works. We always know that like 2 weeks after they report the jobs numbers lately, they come out and revise them. Last time they revised them down by 180,000. Oh, we accidentally counted 180,000 more job applications, job employment than actually happened. How does that happen? How does that happen? I don't know. I don't think it has anything to do with politics or the fact that we got a financial meltdown in the markets, or that there's a pending, or that there's a presidential election or anything. I don't think it has anything to do with that. There is nothing to do with that. All right. These people who make these reports, they are the best. They're the best. They know their numbers. All right. That's how it goes. Fact or fiction is a great question. Makes you wonder, doesn't it? Okay, here we go. So onward and upward. That's what we got going. So at 8 o'clock, we got Michigan consumer sentiment. That always comes out with red and hardly ever moves the market. But we'll see. Maybe if it's a big number, maybe it'll move. Maybe that's why it never moves, because the consumer sentiment doesn't change much. But it's been changing lately. I mean, look at this one. The University of Michigan consumer sentiment. The U.S. was revised higher to 7. Surprise! Sentiment September is the highest of 5 months from a preliminary reading of 69 and beating market expectations of 69.3. So, all right, consumer sentiment. really high. Everybody's in love with these markets. Okay, I guess. The university says so. It must be so. Let's go back over here. So then we come in here. We got Fed Bowman speaking at 11, and then the monthly budget's coming in, and they don't have that date, that time on there. So that's what we got. A couple of Feds speaking, and then Michigan consumer sentiment at 8 o'clock. So maybe the market will move around 8 o'clock. Let's jump back over to this one. So we'll look at the NASDAQ. That's what the NASDAQ's doing. The market opened a couple minutes ago. So 730, right there, 730, way back here. So there was the market open right there. So we should draw a marker on it. Right there was the open preferences, vertical. So that's what the market's doing right now. We're not going to trade it. We're not going to trade it. We're not going to get excited. We got to go over and do seasonals. And seasonals generally takes us the whole class. So I just can't not watch it for just a minute here, though. I love to watch it for just a minute. For just a minute, I like to watch it. This is a range bar 15. And that's still going too fast to trade. If we slow that down, let's bring that down to, let's go to 25 on that NASDAQ. That's a little better. Slow it down just a little bit. That's what it's doing, though. The market's just flushing down. Let's go look at a daily chart on the NASDAQ. So we're getting that. This is the NASDAQ, not the S&P. So you're seeing that the high-tech stocks are not breaking all-time new highs. So highs are way up here. We haven't been looking at the NASDAQ on a daily chart. We've been going over and looking at the S&P. And the S&P is breaking all-time new highs back in here. So that's our all-time new highs. We then had this little dip right in here, and it's breaking, and those blue lights right there gave me confidence. I went in and started putting money in the market, believe it or not. Nope. Believe it or not, even though I said I wasn't going to do anything like that until after the elections. But that's just a buy signal that I just cannot ignore. I must say it's just a buy signal I could not ignore. But I thought we were going to get a bunch of this. I thought we might get this, and we kind of did right in here, right? But then look, flat bottoms, little flat bottom girls in there starting to head up, break those blue lights. You can't ignore a buy signal, guys. You just can't ignore it. That's the little flip-flop thing that we like to see. Doesn't mean it can't turn around and give us a third arrow down. We see that sometimes. And if we get that third arrow down right soon within about the same time frame, then we'll look for the flush. But if we don't get it, we got to buy. We got to be buyers right there. You just got to do it. That's what the rules are. And you got to obey the rules on the S&P. But if we take that over here and we look at the NASDAQ is not doing as well. The NASDAQ is the high-tech stocks. And so if you're trying to expect the high-tech stocks to do the same thing, you're not getting the same follow-through. There's our buy signal. Tried to break it yesterday, but it's fallen back against it today. And that's why we're getting this flush back down. Look at this. And it may drag the S&P down. I don't know. The S&P may not be able to rally. It's already turning into just a little, look at this, lower highs. We're coming in here. Today will be a very decisive day on what happens. It's already coming into a little triangle wedge pattern right there with the lower highs. That should not have done that. That should have broke those blue lights and kept going. Now it did yesterday close above those blue lights, and it's above the blue lights right now, but it's lower than the previous day, and it's lower than the previous day. So it's going into a little triangle formation there, a little pennant formation, which is, well, it's usually a continuation formation, so we shouldn't worry too much, but it doesn't mean it can't be a flush formation too. I mean, it can break out of a triangle going either way. Of course, it can also do one of three things. Markets can do one of three things, right? They can go up, down, or sideways. So that's kind of what we're looking at, but that is all bullish right in there. Everything's bullish, so we should remove these for now and just say we're going to look for this thing to go up. And I took the buy signal. I did. I have to admit, I took the buy signal. We'll see. I got a tight stop. I'm not gonna play loose with this one. This is not a loosey goosey. This is a tight stop. What about the Dow? Oh, wow. That's a good move in the Dow this morning. Look at the Dow breaking all-time new highs. Look, there's that buy signal on the Dow. That's really good, really positive for the Dow 30. 30 stocks, 30 big stocks, all saying, let's rock and roll, man. Let's rock and roll. So you can't ignore the buy signals. That's another buy signal right there. Now, and then we're in second drive. This is drive 1, this is drive 2, and that's going into drive 3. How long do we expect drive 3 to be? Well, we expect it to be close to the same distance as drive 2 and drive 1, right? Probably be up in this region, 4,900, somewhere up in there. Let's see. So, all right, I guess it is what it is. Let's come down and see what we got down here on the range 15. That's really nice. What about on the range 6? Range 6. Well, it's not doing so good here. It looked really nice on range 15. How far back was that? 737. Where did the market open? Man, it took off like a rocket ship out of here, didn't it? There's the morning bell right there. Right there. Is it back here? 722, 730 right there. That's the morning bell. We drop that in there. We're going to come into our preferences, set that up like that. That was the morning bell. So we're getting the flush back down to VWAP, probably back down to here. You think it'll come back down? I'm having a problem here. What happened? How come my chart jumped? Okay, let's see. Well, we're breaking higher, staying below the blue. It's bouncing off that 50 with an ABC. That might be right there. If that thing, that might be a drive 1, counter trend, little drive 2 in here. And we could get a next third drive back up. I don't know. Little butterfly patterns, what that would be, right? Little butterfly in here. Like that. It's breaking higher. Wants to go. Got the previous high right in here. See if it can break above that. This is the range bar 15. Heikin-Ashi bars. No, it's breaking down. It's not going to break higher and give us that wing. Well, it might give us one more bounce up. You know, touch those yellow dots. Come on, baby. What you going to do? What you going to do? When they come for you. Let's see. Yeah, there it goes. There's the break. There's the break higher. See if it's just going to wander sideways or if it's going to continue the trend up. It should continue up right there. First candle, break a new high. It should go, go, go. Go, go, go. There we go. There's our next arrow. Break the high. Keep going. Give us that upward wing. There it goes. How good are you at predicting the market direction? Just practice this for a while. You don't even have to trade it. Just come in and see if you can predict where you think that market's going to go based on price action and recurring price patterns. What has markets done in the past? Well, how do I know, Lan? I don't know what the market's done in the past. Well, go get my book. It's in my book right here, The Stock Market Playbook of Strategies. It's out on Amazon. Lan H. Turner. Just search Lan H. Turner. There's several versions. Don't get the old version. Get this new version right here. Stock Market Playbook of Strategies. New and improved. All right. Lan H. Turner. Go out to Amazon, get that, and that'll tell you all the little patterns that we're looking at here. So that'll help you. And then just practice. Just sit here and say, I think the market's going to do this. I think the market's going to do that. I think the market's going to do this. And then you draw it out. That's what these tools are for. And then you see how good you are at predicting the market. And when you get pretty darn good at predicting the market, and you're like, wow, I'm getting good at this. I can really predict where this market's going to be. I can draw my Fibonacci rulers. I can go back to the center cone of probability. I know where that's at. Oh, and I do it, and the market does it often enough. I'm pretty good at figuring out where this market's going to be. When you do that, then you can start placing orders. All right. You can say, well, I think it's, yeah, I've been right on this about 9 times out of 10. Last time I've done this, it's done what I thought. I think I'll go ahead and place an order, make some money on it this time. That's how you trade. That's how you learn to trade. Just practice. Practice trying to predict where you think the market's going to go. That's what trading's all about, right? Those who know where the market's going to go the best can predict where the market's going to go the best, make the most money. Use your indicators. Use your technical analysis indicators. Well, I don't know anything about indicators, Lan. How do I learn about indicators? Oh, I got a book for you. It's out on Amazon. Just go search Lan H. Turner, and you can get the book. And it tells you about the indicators and how to read them and what you're supposed to look for. It's the workbook. It's a workbook. Don't think you're going to read this thing in bed at night like a novel, unless you just want to get put to sleep. Go ahead. But this is more of a workbook. You're going to lay it out on the side of your computer on the desk, and you're going to go through it like a workbook. All right. That's what it is. Go get the workbook. We got class tonight at the university, and we're going to go through the Fibonacci Elliott wave, and we're going to go through the accumulation distribution model from Mr. Wyckoff, and we're going to practice that in class tonight. So get ready for that if you're part of our class at the university. We missed Wednesday's night class. I had a massive technology failure and missed my Wednesday class. And everybody was writing me letters going, hey, where are you? Why aren't you in class? Aren't we having class tonight? I couldn't even write them back because I couldn't get to my computer. Finally got my computer working again to the point where I could write them back and said, sorry, missed class. So we're going to have class on tonight, Friday night, and then also on Monday. We're going to have to extend our class until Monday. So our last class at the university will be up Monday night. All right. For those of you who are part of the university, want to take those classes, we're going to practice our Elliott wave, Fibonacci, and accumulation distribution model tonight in class. All right, let's go do a little of that. Let's go over, we've watched these markets enough. Daily charts, taking off like a rocket ship on the Dow. NASDAQ, not so much. We wish it would do a little bit better with those high-tech stocks. Russell, flushing down. Look at this. It's too bad we can't do options on the Russell, because that would have been, look at the options chain on this Russell. We come over here and go to the options chain. 0 days till expiration. There's nothing there. Nobody trades these. We get nothing. No volume, no open interest, nothing, hardly anything. It'd be too bad, because that would be a really good dead market that we could sell some premium on. We could go take somebody's money. We could go take somebody's money here in the Russell. We might be able to do it over in the stock market, but who wants to do that? All right, I'm just kidding. Of course, we're going to go do that. Let's go look at that one. This is the S&P. The S&P is where we got all of our options chains. So if we want to do that, we have to do it over here. But the S&P it's moving and shaking. Well, I don't know. Not so much today. Look at that dead market. We might be able to put on a wild eye, crazy eye, iron butterfly, Bruce, one of our over the weekend butterflies. Let's go look at the stock market and look at the seasonals, and then we'll come back and maybe, of course, it's good to put it on right now, isn't it? Of course, we got sentiment coming in 10 minutes. Implied volatility is at 9. I don't know. Maybe we ought to put them on. You think we ought to put them on? Sell a call? We could do it right there. It's not right at the VWAP, but it's right darn close. Sell a call, sell a put, right at the money. We could do that. If we wanted to do that, we need to buy them first, though, don't we? So we can buy the threes. We'll buy a call, and we'll buy a put. We'll put them right there. We'll go ahead and see if we can get into those quick. And then we'll go ahead and we'll sell a call. I got to go back to zeros. I'm putting them on different sell a call and sell a put. And I'm putting them on different tickets. See if we can get into those just as quickly. We got into them. All right, we got our wild eye, crazy eye, iron butterfly. And we'll let that run over here in the futures market while we've got sentiment coming in 10 minutes. And then we'll go over and start looking at our seasonal stuff. Okay, so this is the stock market, and that is the S&P in the stock market. So that's where that sits, and we don't have any orders on. We got a few orders on some of these other things. We got Home Depot's kicking our butt right here. We bought a put option in anticipation of that thing flushing right here. I thought we might get a flush back at this point, but it turned and pushed one more higher. Maybe we'll get the flush now. We're holding on to it for a little bit. We've got we got all the way out here to the purple line. This is a put. This is a bear put spread with a naked leg. Bear put spread with a naked leg. All right. So we're going to collect on this thing $560 on the top one. That's what we're receiving. And then we're paid $1,300 for that put option, and it's down $350. We received $610 on this put option, and we're up $217 on that one. So if we just come down here to the chart itself, you can see that we're down 260. We got a 215, 380, 95. So we need that market to drop. We need the Home Depot to give us a little bit of a pullback, a little bit of a retracement in here. That blue light's coming in. Looks like it wants to intercept. We came in a little bit early on that one. I thought that we'd get a little intercept sooner, but it's coming in a little bit later. But it's okay. We just don't, to make this thing work, we need it to fall a little bit down in here, below the green line at least. I'd like to see it below the red line. That would be max profit. Anything below the red line down here would be max profit. Anything below that red line, max profit. Max profit. So that's what we got there. That's the hurting one, 260. Coca-Cola's really painful. That's down $1,000. But and remember, we thought we might go for a third drive on this, and we didn't get the third drive pattern. Drive 1, drive 2, and we were looking for drive 3, and we didn't get it. It's fallen back. And we bought a leap, 343 days until expiration, and we paid a lot of money for it. We paid $5,800 for it. Is that what that says? Yeah, $5,850 is what we paid for that leap. And that leap is something we're going to sell. We're going to sell we're going to sell options against. And so that's what we did here. This is a poor man's covered call. So we're selling options. We got 5 of them. All right. Because we bought 5 long calls, and we're up $27 on our, on our call. So over the period of up until that, grabbing the wrong thing again. They changed the way we do this. Let's see. So this purple line, I got to that purple line. They'll give me $275 if I hang on to that option up there until that purple line. I get $275, and that'll go against the cost of this expensive option. But we do want to see Coca-Cola rally. We want to see Coca-Cola rally. It doesn't matter if it comes down here. It's okay. We'll get full profit on we'll get full profit on this anyway. But the profit will stop. Oh, I put that in just like right here, like I put it in right here. So we're okay. I think we took the profit on the other one we had up there, a little bit of profit. I rolled this down because we had max profit. That's what happened. We had max profit on the previous sold put up there, and I rolled it down to get more profit because all I was going to be able to make was $90 between here and here. And if I roll it down, I could make $250 instead. So I was like, well, I'd rather make $250 rather than $90. Which would you prefer? Which would you prefer? $250 or 90? I hope you said 250. Of course, we have to take greater risk with 250. We had to bring the option down, but the market fell. But it's not that much risk. I mean, the market took off and went above it. We would lose everything above that red line until it hit that purple line and we start making money again. But that's the name of the game. I decided to take the 250 instead of the 90. Okay. Microsoft's just wandering sideways. It's okay. Oh, we did a big one here. So what is this? We bought a call and we sell a put. Oh, this is what the heck am I doing here? I bought a call in anticipation of a continuation of the uptrend in Pfizer, and I sold a put to help pay for it. Is that a naked put? It is. There's nothing down there. That's a naked put. Oh, no. There's up there. What did we do? We received money up here. That's a naked call. I don't know what the heck we got going on here. We sold this one way up here for $210 against that one, and we got a naked put. Okay, so that's what we did. We bought 10 long. So we need the market to rise, and it's not. It's falling back down. But we also sold premium out here. So we collected $210 on this one. But why does it do that? So we collected $210 on this one, but it can't go above that red line. It's got to hit the purple line before it goes above the red line to get our full 210. And I think we're fine there. Problem is we got this 98-day. Oh, see, these are 35 days, and then this is a 98 day. So we're testing to see, this is a quarterly leap strategy. So we're going to look to see if this thing won't rally. We get an opportunity to sell a couple of options against it to help pay for it. But the market does have to rally to make money. I don't like this strategy very well. And then in here we got the put that are the ones that we sold. So we sold these to receive $200. But if the market comes down there, we're going to end up having to buy. If it hits that purple line underneath that red line, we're going to have to buy 100 shares or more than that, 5,000 shares. 5,000 shares. Oh, let's see. They changed this all around on me. I'm not used to it. Changed our scrolling and scaling in the software. I'm not sure if you might not have this update yet. They might have just given it to me because I'm so special. Look at it, try out all the new features first. They changed the way we scroll and scale, and I'm just not used to it. Okay. So that's what's happening there. I'm not sure if we're going to make money on Pfizer. It's going to have to really rally and not go up to that red line to make money. Let's see. Procter & Gamble. Procter & Gamble's handing us our hiney too today because this was a long call. This was a bull call spread with a naked leg, and it needed to rally and go above that green line. And I really am having a hard time with this thing. Why can't that not stretch it? And then this thing here needs to come up here. That's where that market needs to go to be optimal profit potential right there. So it needs to be above that green line and hit that purple line. This one here, we'll collect that $170. We don't have much of a risk on here. See this? So $202 we're collecting here. We're collecting $170 there. If you add that together, that's $372. And then we paid $410. So that's our max loss is the difference between those. 372, 410 minus 372. Our max loss is only $30. The worst we can do on this thing is $30. Well, I guess the other thing, if you call it worst, but the other scenarios, it could be way down here. And if it's way down there, then we would have to buy $16,000 worth of Procter & Gamble, which would be 100 shares, which wouldn't be bad. That would be a nice place to buy some Procter & Gamble anyway. Then we could start selling covered calls against it. But that's what that's doing there. We're down $157. Other than that, they're all green. The rest of them are just making a little bit of money, making money. Oh, Tesla. Look at the flush on Tesla today. Oh my gosh. Poor Tesla. Poor Elon. What's happening here, Elon? So we got up here. We received 540. We paid 257. So that's just a chicken wing up there. That's just a vertical spread. So we're going to collect the premium, and that's our protection we had to buy, the insurance premium. We paid 257 to collect 540 against this naked put down here. So this is a naked put down here. So if Tesla comes down here, we're going to have to buy some Tesla. Are we prepared to buy some Tesla at that price? I guess we are, because we put in an order to buy some Tesla. That would be $18,000 worth of Tesla that we'd be buying at that level. If it comes down and touches the purple line, if it touches the purple line underneath the red line. Okay, so I guess that's how that works. All right, anything else you want to quickly look at? Chevron, bull call spread with a naked leg. It's just making money. It just needs to go up. That's all we want on that one. We'll wait till it makes max profit, then we'll take it. JP Morgan Chase. Oh, that's nice. I nailed that in there. That's an X1SA1, which has a low probability of success. That's like playing with a pair of twos, and it's making money for us. So we're getting paid off with our pair of twos. It's not even a 17. It's not a couple of aces. It's not a king and a jack. It's just a pair of twos. Yeah, you could say, Lan, that's not a pair of twos. That is a 17. You could say that if you wanted to, but I think this was too much of a reset right here. We could also say, I mean, why not? You could say this is drive 1, this is drive 2, and this is starting drive 3, right? I mean, it's ugly. We got the reason I don't call it that is because of this huge reset. And it came all the way back down to the beginning. And then this one rallied hard, and then it got a huge reset. And when I get big resets like that, I generally start the count over. But here with JP Morgan, you got to admit, it could be very well, that could be drive 1, that could be drive 2, and that could be drive 3. And that's what and what are you talking about, Lan? Drive 1, drive 2. And why do you call it a reset? And it might not be a reset. What? Well, get my book. It's in the book. All these drives, these X1SA1, they're in the book. Lan H. Turner. Go get the book and you'll understand what I'm talking about. It's the manual to the class. This is the accumulation distribution model of, we call it the Wyckoff accumulation distribution model. He's the guy that came up with this idea. And I mean, he didn't really come up with it. He just kind of explained it to us, and so that we could understand what was happening. It's the way the big banks accumulate their shares. All right. The way the big banks and the hedge funds trade. And so he's telling us, hey, this is what the big banks do. This is how they buy into the markets. They're the only ones that can move the market. We can't move the market. You can't move the market. Lan Turner can't move the market. We're not big enough. But the big guys, the big boys, the big girls, the big boys and girls, whichever you want, they're a combination of each, right? They're teams of people. I just call them the big boys. So the big boys are the banks and the hedge funds. And so they're the ones who move the markets. They're the ones who buy into the market. They're the ones who sell out of the market. They're the ones who move the markets like this. Now, the retail traders, we have a tendency to be able to help with this, actually, believe it or not, this one, more than this one, because we like to bail out of markets fast. So we can buy in, and then we all of us little retail traders, when we get all together, combined, we're kind of like a big hedge fund, right? I mean, you and I individually can't do anything, but we as retail traders combined, we can do a lot. We can move the market. And so the problem is that we're all dumb and fickle. And so the big banks and hedge funds, they manipulate us. They tell us what they make us do things that they want us to do. And they do it by manipulating price in the market. They're big enough, they can pop the market, they can drop the market, they can move the markets around a little bit. And so they know that we retail traders sit on the edge of a sharp knife all the time, wondering whether we're going to buy or sell. And so they can just move the market and do something, and then they can manipulate us into doing what they want, which is either buy up or buy in or buy out. But they manipulate us as a one individual entity. And so that's called the accumulation distribution model by Wyckoff. And then the big hedge funds can buy low and sell high, but by manipulating us and making us sell our shares to them, and then they sell out to us. And so that's how it works. And so these drives are times in which the big banks and hedge funds have a tendency to make these things happen. All right. They move things around. They move the markets around. They move money in and out. And they manipulate us small guys so that they can take our money. And so these big runs like this are manipulation of the big hedge funds, getting us to buy into the market so that they can then sell out everything they bought here. So they bought on these big bottoms, these big dips down here. They bought a whole bunch. You can see all the volume down in here. And then a big bottom bar. And then they start to turn the market. All of us retail traders, we buy in, buy all the way up that trend. Well, that's where they're selling. They're selling all the way up that trend. And then when they get out, they run out. Oh, we don't have any more shares to sell. They flush the market again. And then we sell out everything that we bought and we sell it all to them. And then they start the whole process all over again. All right. So that's why, and they generally like to do that 3 times. They go through a process of flushing that market, or manipulating that market 3 times. And that's why we're always looking for that 3 drive pattern. But when it resets that much, sometimes I think, well, the market's got a complete reset. Let's start a new 3 drive pattern, because usually we get a higher highs and higher lows, higher highs and higher lows, which we are. I mean, technically speaking, you got this low here. This is higher than that one, and this one's higher than that one. So it's a higher low and higher highs. I mean, that's technically an uptrend. So you got to give them credit where credit is due, right, guys? So this could not be an X1SA1. It could be an X3SA1. Very well could be an X3SA1. No, it's not an X3SA1. What are you talking about, Lan? You better go look at your own book. That is probably, if we look at it from that standpoint, from the accumulation distribution model, that's not an X1SA1. That would just be a flat out C1, wouldn't it? Bruce, help me out here. That's a C1. That's a C1 slash, well, there's no slash. It's just a C1. That's a C1. Okay. We got some guys giving me, go look quick, go Lan, you missed the report. There's our option that we put on. Trade. Let's go back over here to the charts. Let's go to the NASDAQ 15. Oh, look at that. That's what happened after the consumer sentiment report. Well, there's 8 o'clock. There it is. That is when the report came out right there. Now, I don't know, because we weren't sitting here watching, but I wonder if that went too fast and we would not have been able to trade it, because it just went too fast. But that is a range bar 15. Range bar 25. Well, that's just all that happened on the range bar 25, those few bars right in there. So it just went up a little bit. Range bar 15 gave us this. Zip, and then flushed back down and went sideways. It's trying to thump higher right now. Looks like it wants to go a little higher. Go, baby, rock and roll. That's the blue line, magic blue line. Went up to the magic blue line last time. That's the VWAP. I'm going to break up to the magic blue line, see if it can break through and go again. Higher lows and higher highs. Higher highs, higher lows. It's in an uptrend, 3 drives. Oh, touched it, just like a train on rails. Touched it, touched that hot little bugger. Touch the hot stove. Let's see if it can break through. Okay, it broke through just like it did here. Now let's see if it can hold above it. That didn't work very good. What the heck is wrong? Man alive. Computers. Didn't want to draw. What the heck is going on here? What the heck is going on here? Oh man, look, that thing shot like a rocket ship up through there. Man, why don't you have an order on? Gonna try and go again. It's crazy, man. Let's see, range bar 6. Whew, it's all over the place. Can't do that one. All right. Well, this market's going crazy over here. Let's go back over to the stock market. All right. So we're going to go in and look at, I've got our seasonal stuff up here. We got to get to that before we end of the day. So here we are. Here's our settings. So we're using the S&P 500. You can see that that's what we got set in here, the S&P 500. We're going to come back over here to accounting. All right, so this is what we've got closed out on our seasonals. Now, what's the seasonal nature market? Markets have a tendency, or they have repeating price patterns, right? So they have a tendency to do the same thing year after year during the same period of time. So oftentimes explain it like a corn farmer plants his corn at the same time every year, harvests his corn at the same time every year, brings it to the market same time every year, susceptible to damage same time every year, too much rain, not enough rain, has storage fees same time every year, transportation costs same time every year. So corn has a very even fluctuation of price that has basically does the same thing during specific times of the year every year. It rallies during specific times, it falls during specific times, it goes flat during specific times, and that's all because of the planting and harvesting season, right? Stocks do the same thing. We have taxes at the same time every year. We have quarterly earnings at the same time every year. We have board meetings at the same time every year. We have all these different things that markets do, whether it's Christmas, holidays, sales, Black Fridays, this type of stuff that affects markets the same, the stock market, as it does maybe a corn farmer. And so that's what we're trading here with TradeMiner. TradeMiner goes back and it finds those reoccurring patterns year after year and tells us what's coming up, which one of these markets are having reoccurring patterns this month. And that's what we're trading right here. So this is the markets that we've already traded. These are the ones that we've closed out. So this is our closed positions. And we closed out at 1395, 733, 2000, 239, 928, 13, 6, and we've had 3 losers: 629, 95, 18, another 22, and a 430. So that's what we've got. We're up so far $5,800 on our seasonal trading. We started this back on August 7th, and now it's October 11th. So August, September, so what, October and September, so 2 months. So in 2 months trading this strategy, we're up $5,800. So we're going to come in here to the portfolio. This is our portfolio view, and this is what we've got trading right now. So we're up $1,719 on our NVIDIA trade. NVIDIA, we are down $340 on our CDW trade, which ends November 13th. So there's a chance it could turn around. Old Dominion Freight, we're down 112, and it ends on November 14th, so there's a chance it could turn around. And then we're up $39 on Amphenol. We put in some other trades. We got Xylem, Snap-on, and CBOE Mobile Markets. These are some that we've picked, and they have not started trading yet. So Xylem comes in on October 14th, which is Monday. Is that today's 11, 12, 13, 14. Yeah, so that'll start Monday. This one starts Tuesday. This one starts Tuesday. So if you look at these statistics in here, then it comes in and says that we're going to start Xylem on October 14th, because between October 14th and November 28th, 100% of the time over the last 12 years, 46 calendar days, this thing has returned on average 10%, a 10% return. So something is causing Xylem between October 14th and November 28th to have a seasonal recurring bullish pattern. Now, we just looked at bullish. We've not been doing any bearish patterns, so we're not buying puts on this one. We could buy calls if we wanted to, but we're just using the trend. This is just an analysis tool, and it's got a portfolio. What you do with your real money, you can go in and execute these things with real money, but these are all calculated as if you put $10,000 into each one. Actually, it's in on $11,060. That's weird. Column user preferences. I thought we said, my total account balance is 53,000. Oh, okay. So it says that as we make money, we can allocate more money to trading. So that's why we're now at 11,060. We started at 10,000, but because we've made money, we can now invest 11,000. So we can do a little compounding. That's what this is doing. Okay. So that's where we sit right now. So these are some of the trades that are coming up that we could look at. These are all scores with 5s. There's Fifth Third Bancorp. Now, we're not trading this one. I mean, it'll trade, but we didn't put it into our portfolio. We didn't choose it. So it might show a profit, but we don't get to collect it as a profit because we didn't put it in our portfolio. This is our pick list, all right? So up here we have the pick list. And I'm going through the steps backwards. You can see I started with our accounting window, and then I'm going to portfolio, which is step 3. We'll go to the neural network, which is step 2, and then we can go to the search tool, which is step 1. Usually when you start, you want to start in step 1, do your searches, and bring everything over to the neural network, let it scan it, then bring it into the portfolio picker. Then you decide out of the portfolio picker, let it scan it, and then it drops it down into the portfolio. So if you guys are not familiar with TradeMiner, I'm kind of brushing over this because we do this every week in this class. And it's difficult to try to explain the whole process every single time, especially for the guys who have been here. They don't like listening to me repeat myself over every time we bring it up. But I got to do it for the new guys. So brushing over a little quick, but we're coming in here. And now just stick with us. You'll catch on what we're doing here. But this is where we're at. All right. So these are the ones that we did not pick, even though they're in the pick list. We can pick from them, but they're not the ones down here. So October 23rd, this one opens on October 23rd. These all open October 23rd. So they all open on October 23rd. They all, on the probability scale, they all came in at medium. Of course, we're still out quite a ways. So the probability gets better. I mean, the AI system is able to better generate better fingerprints the closer we get to the date. So we're still quite a ways out. And they all scored 5s. So the score is 5. That's the highest score you can get. And you look, the ones down here, these all scored 5 too. 5, 5, 5, 5. And they're all up to get trade. Well, this one here started trading. That's our first 5. Amphenol, October 10th. Ends on November 7th. And it's up $39. Little disappointed in these. They had high probability, but they didn't have the highest score, 3.2 and 3.1. And they're losing money. But we've got a good one here with NVIDIA. NVIDIA, believe it or not, as much as NVIDIA's been in the news, traditionally speaking, between September 24th and November 7th, 82% of the time over the last 11 years, NVIDIA has averaged 13% return. And we're up 15.54% right now. So that one's right on track, just like a train on rails. It's just doing the same thing it's always done. People are like, oh, yeah, well, that's NVIDIA. And NVIDIA's in the news right now. And it's done the same thing 82% of the time over the last 11 years. So it's not like we picked NVIDIA and just yanked it out of our heinies because it was busy this year. We wouldn't have picked it if it hadn't been making money. At least look, we said the minimum was 10 years, and it's been doing it over the 11 years. Look at that one, 32 years. Amphenol, October 10th to November 7th, 91% of the time over the last 32 years has returned 8% return during this time frame. So, is there something to it? You tell me. I'm just a tech support guy. All right, let's come in here to the neural network. Now, the neural network is coming over from the previous scan that we did for the month of October. These are all in the month of October, and they're all towards the end of the month of October. We got October 15th, 14th, 10th. We sort by October. This starts the 10th. That one already started to go. So, that's the one that's up $39. That's Amphenol. There's Xylem. That one starts on October 14th, so that one's Monday. And then as we go down, these are more. Now, these are some of these we picked. Some of these ended up over here in our pick list and then down in our portfolio. So that's the ones that ended up in there. If we take these out of here, I don't think that we can. If I take these out, I wonder if it removes them from our portfolio. I don't think so. Let's try it. I don't know. I'm just a tech support guy. Let's come in here and find out. That's how we find out, right? Just remove selected. Did that pull them out of here? It did. It pulled it out of our pick list, but not out of our portfolio. So our pick list now is empty because we took them out of the neural network. Because we're going backwards. Remember, we're going through the thing backwards. We should start at the search engine and and go forward. All right, let's do this. So search for trends in the month of, and we're going to do the month of October. We can do individual stocks if we want to, but we're going to do the month of October. We're going to do the entire month. We want to find out what seasonal trends happen in the stock market in the month of October. Just like corn has a seasonal pattern, we're going to look for stocks seasonal pattern in the month of October. Find trends that have won at least, and we're going to put in here 80% of the time. We could make it more tight. We could say 90% of the time, or we could loosen it up, say 70% of the time. But we get enough results usually that we can, 80 is kind of a good number. We can make it higher, and we could run the scan twice. We can run the scan as many times as we want, right? So 80% of the time showing, and we got in here both bullish and bearish, or bearish only, or bear. I told you at one point I was going to do just bearish. And if you do just bearish, that would tell you which stocks basically not to buy into, right? You should not be trading these in this time frame. So that's what that would be telling us if we did bearish. Or it could be saying, hey, you want to go out and buy some put options, take some short positions. That's what we would do with bearish. But usually in the stock market, most of us don't take short positions, right? We're just long traders. So if you would look at this, you could say, well, I probably shouldn't have this in my portfolio during this time of the year because it's bearish all the time. So let's run that scan. We're going to do a bearish scan right now just for fun. List trends that last at least 10 trading days, but no more than 35 trading days. Find at least 10 years of history. It can be worse. We're going to do bearish. So bearish, at least 10 years of history, but it can be better than, it can have longer than that. It just can't have anything shorter. We're going to remove the same symbol duplicate start dates and remove the same symbol overlapping dates. We're going to scan, okay? So we're going to find bearish trends. So this markets that have a tendency to fall during the month of October. Now, we should have done that last month because we couldn't find anything that rose last month, and we lost money last month. All right, here's the ones that fall. Now, they don't fall very good if they got yellow. Let's find a high score. Oh, we don't have any high scores in October. Look at that. The best we can get is yellow. October, traditionally speaking, looks like a pretty bullish month. We know that it's a pretty volatile month, right? The seasonals told us that in Pitt News Magazine. Pitt News Magazine? What is a Pitt News Magazine, Lan? I'm new here. I've never heard of Pitt News Magazine. Well, thanks for asking. Glad you asked. Pitt News Magazine is the club magazine. You got to have Pitt News Magazine if you're going to be one of the cool kids, all right? In fact, for those of you guys who have not heard about Pitt News Magazine, Claire's here, and she wants to mention something to you. Hold on one second. Here's Claire.
Hey everyone, it's Claire here. Are you ready to take your trading knowledge to the next level? Welcome to Pitt News Magazine, your trusted source for trading intelligence. Whether you're a seasoned trader or just starting out, this magazine delivers the insights you need to stay ahead of the market. Featuring articles from experts like Dr. Scott Brown, Aidan Gray, myself, and of course Mr. Lan Turner. Pitt News brings you exclusive strategies, deep dives into market psychology, and powerful trading techniques. Find out about the exponential power of growth, seasonal trading secrets, and even Lan's latest wild eye, crazy eye iron butterfly strategy. Each issue is packed with expert trading strategies, top stock picks, key seasonal trading insights, and comprehensive analysis of commodity futures and ETFs. You'll also find tips on technical analysis, option strategies, and much more. No matter your trading interests, we've got you covered. And the best part? You can learn your way. Listen to each recorded article, read the full in-depth lessons, or watch our video breakdowns. It's trading education on your terms. Right now, we're offering a special deal. Get your first full year of Pitt News for only $19.97. That's 50% off the regular price. 12 issues of powerful trading insights, backed by our 100% satisfaction guarantee. So, don't miss out on this limited time offer. Head to pittnews.com and subscribe today. Empower yourself, enrich your trading strategies, and stay informed with Pitt News Magazine. Trading intelligence right at your fingertips. Okay, let's get back to Mr. Turner. Thanks for sticking with me.
All right, there's Claire talking about Pit News Magazine. In Pit News Magazine, we put in seasonal trades in it every month to get your seasonal trades, and we also have an article in there that talks about the seasonal nature of markets and explains this whole thing to you. So that's a great thing in there. And this is the one that's telling us we should not be trading in the month of October. So if we sort it out there, Chipotle Mexican Grill. Between October 1st and October 29th, 83% of the time over the last 12 years has lost 4% on average. How about that? Nobody wants to be eating Chipotle Mexican Grill in the month of October. So that's a bad time to be buying Chipotle. So if that's in your portfolio, you probably want to, during October, probably want to take it out of there. Get it out of there. It's a loser. Doesn't mean it's going to lose this year, right? This is just what it's done in the past. And as we know, past performance is not necessarily indicative of future success, but doesn't mean that it can't happen. All right. I always say, may not happen, but it's the best information we got. Nothing better. So we got international business machines between October 9th and October 29th, 80% of the time over the last 10 years has lost 6%. Now, it hasn't done that this year. This year, there's something wrong with IBM, and I don't know what the heck it is. I think it's AI. But holy smokeroonies, have you seen IBM? It didn't go down this time. Let's go look at IBM just for fun. I'm sure you guys are all familiar with IBM. You've all got IBM on your watch lists, right? Look at that bugger. Holy cow. What in the heck? You know, IBM is one of these stocks that generally just kind of wanders sideways. It's pretty big blue chip stock, and it doesn't really do a whole lot. They give a little bit of a dividend. They pay a dividend. And so a lot of people trade this as a dividend stock, and they don't really look for it to have a lot of growth. They don't look for it to fall. Nobody expects IBM to go out of business or go down. They just kind of expect it to slowly, go up a little bit every year and then give them some good dividends. It's a pretty safe place to put your money. But man, look at IBM this year. Holy smokes. That thing is on fire. Look at how many drives that thing's made. We started down here with this low. We made this little ABC pattern. We're not going to count that one. We're just going to count this one as the first drive. Drive 1, drive 2, drive 3, drive 4. We're into the 5th drive. That's unbelievable. Just craziness. And so that seasonal trend is not holding true on IBM this year. That is for sure. Look at Perigo. Perigo, between October 18th and November 18th, 80% of the time, over the last 10 years, 22 calendar days, that thing's lost 5%. Let's see if there's any other. Carnival. Carnival Cruise Line. Now that one too, I think is, let's go look at Carnival because I think it's gone to the moon. CCL. Has it not gone to the moon? CCL. Wow, look at that thing. Woohoo. Here's our previous high. We made a bunch of money on this one, remember? We traded this one up through here. And then the thing flushed like a toilet. We got out. We were okay. Didn't hurt us. And now look at this. I haven't been trading it lately, but this is nice. A 3-drive pattern. Drive 1, drive 2, drive 3. Actually, I think we did get in down here, didn't we? Didn't we get in on our I didn't do this in my real money account. I remember, but I think we did in our classroom account. I think we got in right down in here somewhere. There's the spider web right there, that break. But spider web, what are you talking about? What's a spider web, Lan? I told you. If you want to know what these things are, you got to go get the playbook of strategies. Spider webs are in there. I talk about them in the book, in the manual. Go read the manual. Did you guys ever remember in class when we were in high school, teacher would always tell us, read the manual. Read the manual. Did you guys ever take the manual home and read it? I didn't read the manual. Not very often. I'd read it in class. I always read the manual in class. But then I threw it in my locker and got on the motorcycle and went for a ride after class. I figured that if I couldn't learn it in school, I was there for 8 hours, then what was I going to learn after class? I needed some recreation time after class. That was not time for homework. That was time for me to go ride my motorcycle. That's the kind of student I was. All right, here we go. Carnival Corporation. That thing's rocking and rolling. So let's go back over to Devon Energy Corporation. To see if there's anything else in here we recognize. There's Dish, there's Western Digital. Western Digital, October 9th to October 3rd is 80% of the time over the last 10 years has lost 7%. Xerox, October 4th to October 28th, 83% of the time over the last 12 years has lost 6% on average. What else? Any others that we see in there that are really big name brands? Newmont Mining, October 21st to November 8th, 80% of the time over the last 10 years, lost 4%. Equifax, Zebra, Kinder Morgan, October 21st to November 4th, 80% of the time over the last 10 years has lost 3%. Tesla, between October 4th and October 22nd, 83% of the time over the last 12 years has lost on average 5%. I think that's sticking to that rule. Poor old Tesla. He's following that one like a train on rails. Poor Elon. Look at that. This month is bad for these guys, for Tesla. October 4th to October 22nd, 83% of the time. Over the last 12 years, lost 5% on average. Have you been holding Tesla through the month of October? Well, you're getting your hiney handed to you every single year. PNC Group, Holog, Align, Biogen, West Pharmaceutical. Now we're getting down into some Estee Lauder. Wait a second. We traded Estee Lauder October 9th to October 22nd. 83% of the time of the last 12 years, it's lost 2%. So it's not too bad. Let's go look at that one. EL. That's one we made some money on. We made money on Estee Lauder. Remember that? And now it's dying on us. So we got in right here. Remember? We got in on that. Was it that one or was it this one? I think it was this one. It was this one right here. We got in right there, remember? And then boom, 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 boom. That took off really fast. We made a bunch of money. And then we had our stop in there and we got stopped out. Now it's flushing back down. But look what it's trying to do now. It's trying to break that downtrend right there. That right there, my friends, says we should buy some Estee Lauder. But didn't it say, how come that's not flipping for me? Estee Lauder, October 9th to October 22nd, 83% of the time over the last 12 years has lost 2%. So it's not a real strong player. October 22nd. So we still got 10 days of seasonally speaking, where Estee Lauder is not a buy signal. So at least, and if you want to get into Estee Lauder here, probably don't want to do it with an option because it's probably not going to burst real hard if it does go up. We could buy some shares though. Let's see, just for fun. Let's go look and see if there's any volume on this thing in the options world. Let's come out here. 35 days is kind of short. We'll see. 35 days. We could come in here, open interest. Well, 11 volume sucks, but open interest is not bad. Where's the spread? Just do calls. Calls. And we're going to do, let's say this one here. Oh, $20. And you're going to, well, you can receive 265 in 35 days. That's 8%. 8% of your premium. You might be able to, in the real market money, be able to bid that down a little bit and get it for 10 or 15 out of your 265. If you wanted to do something like that, you could play that game. That might not be fun. Let's try it. Let's go in here. We're going to buy 100 shares. Boom, 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 boom. We just bought 100 shares of Estee Lauder, $9,568. Okay, not too bad. We got $88,000 of buying power, so we just used 10 of it, or 9,000 of it. Now what we're going to do is we're going to come in here and we're going to sell because we don't think this market's going to go very far, very fast. We're going to sell that baby right there. That's only 35 days. 35 days. What do you say, guys? You think that's a good deal? We put out one more. That's $162. I think we're just going to do this one right here. Now, if Estee Lauder takes off and goes to the moon with our shares and goes up there, anything above that purple line we won't make. So we'll start losing money. So our break even is 265, 265. Ooh, that's right. Let's make this thing like that. Come in here. 265. Come on, land. That's close enough. Close enough for horseshoes right there. So that would be where that market would stop making money, right there. Actually, it stopped making money right here. How come this thing could turn off the auto scale? Okay. So that's how that would work. If we put it out one more, 267, what's the chances of the market going out there? We're only going to make $162. And then the $162, but the difference would be 162 is about right there. And then the market would have to go out to that point. So if we thought that, if we thought that thing was going to take off and go to the moon like it did before, we'd want to do the further one out, because then we would make more money, right? We'd make the money between this line and the red line up there, which would be $1,387. I think we're going to take the closer one in. It just depends on whether you think this market's going to rock and roll and take off like a rocket ship again. And let's just delete all the tools. Let's go ahead and put that one on, shall we? That's a covered call. Just a standard covered call. So we'll just mark it into that. We're just going to sell that baby right there. So we're just saying we're going to buy it here and we're going to sell it there. And they're going to give us $260 to say that. And if it goes up there and touches the purple line above the red line, we'll make on this one $937, and we'll collect $260 there. That's a, what? 9, 10, 11, 12, $1,200 trade? That's a $1,200 trade if the market will go up and hit that purple line above the red line. Now, if it doesn't go up there and hit that line above there and it closes out somewhere down here, well, we'll make a little bit less. Make a little bit less on the shares. We won't lose our shares. So if let's say it goes there, we'll make $698 and we'll still make $260. So we'll make, let's say, 7, 8, 960. We'll make $960 if it touches there. Well, what if it touches way down here, Lan? Well, you'll make $300 plus $260. So 3, 4, 5, 60. What if it touches down here, Lan? Well, you'll lose $640 on the shares, and you'll make $260 on the option. Well, what if it comes to right here at $260, Lan? Right there. Well, then that's your break even to the downside. That's where you don't lose any money at all. Right there. Okay, that's how it works. Okay, let's go see what else we got going. So we got one trade-off because of Estee Lauder, because of we're selling a covered call against some shares, all right? Because we don't think the market, why is this not working? How come I can't get it to flip? There it goes. So that's one that's happening there. Anything else down here? Hershey Company, between October 24th and November 6th, 80% of the time over the last 15 years has lost 2%. eBay, between October 7th and October 30th, 83% of the time over the last 12 years has lost 4%. So these are stocks that you don't want in your portfolio during this time of the year. But Lan, you just went and put Estee Lauder in your portfolio, and this is a don't put one in portfolio. Well, no, we got a buy signal over there on Estee Lauder. So we bought the shares, but we sold against it. So we're going to collect premium. So different strategy, but it's okay. I understand what you're saying there. I'm kind of there with you. Royal Caribbean, we already saw that one. Anything else down here? Estee Lauder, Ralph Lauren, T-Mobile, Phillips 66, Conagra, Hess, Netflix between October 31st and November 13th, 80% of the time over the last 10 years has lost 1%. So that would be a neutral option strategy. You could go put that on around October 31st, Halloween day, put on a neutral option spread. Go sell some premium. Go put on an iron butterfly or an iron condor. Let's do that. Let's keep that in mind. Netflix. We're going to trade an iron condor around the end of the month. All right, let's run the scanner to see what we should buy in the month of. This is all the stuff that we should not have in our portfolio. Let's come in here and we're going to say in the month of October, we're going to find them that are bullish. Trends that last at least 10 trading days, no more than 35 trading days. So we like kind of that month-long time frame. Find at least 10 years of history. Again, it can be longer than 10. It just can't be any less. Search. See if there's anything good to buy this month. Now, we already did the scan for October. We did it last week, and that's what was over there, and we've been trading. We put some in our portfolio. But let's look and see if there's anything more fun that's coming up today. Look at all these fives. Holy cow. Wow. Look at all the fives. We're just going to grab all the fives. That's too many trades. We can't trade all of them, so we're not going to have to worry about anything but fives. We'll add all the fives to step 2. So we'll come down here, add to step 2, come over here. Let's look down through them real quick. My goodness, there's a lot of them. So these are some we've already got selected. 1, 2, 3, 4. So Amphenol, Microsoft. Look, there's Microsoft. October 11th to November 19th. 82% of the time over the last 11 years, this baby's made 9%. Let's go pop over and look at Microsoft, shall we? MSFT. Oh, we're already in Microsoft. Wait a second. What did it say it does? October 11th. Today's 11th. Today's the day. Today's the starting day of a new bull trend. Well, that's what it says. And we're okay with that. That's what we want it to do. We want it to rally right now because these are sold options. Remember, we talked about diversification, and we decided to do vertical diversification instead of horizontal diversification on this particular stock. Remember horizontal diversification versus vertical diversification? What's the difference? Let's say you go in and you go Amazon, Apple, Netflix, Google, Meta. What are those? Those are all the, kind of the ones that are the fabulous 7, the magnificent 7, right? So let's say you go in and you do the same strategy on all, let's just say 5 of the 7, or let's just say 4 of them. Okay, so you go in and you put a bull call spread on this one with a naked leg. Bull call spread with a naked leg. Bull call spread with a naked leg. Bull call spread with a naked leg. You're like, hey, I'm diversifying. I'm buying 4 different stocks. But those 4 stocks are all tech stocks, and they all have a tendency to do the same thing. So if this one falls, this one falls. If this one rises, this one rises. Same, right? They're kind of the same. They kind of go like porpoises, and they all kind of do the same thing. So if you diversify horizontally, meaning that you go in and you put a bull call spread with a naked leg on this one, a bull call spread on this one, then this one, and then you have a sold put on this one, 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 all basically 1 strike or 2 strikes out of the money, and they all fall. That's horizontal diversification. You're going to get hit on all 4 of your stocks, and all 4 of your premiums are going to get hit. Horizontal diversification. What if you do vertical diversification? Let's say we only trade 1 stock, and so instead of putting 3 premiums across at the same level on all 4 stocks or all 3 stocks, we go into 1 stock and we go vertical on the diversification. So now the market has to not only fall to fill 1, it has to fall again to fill 2, and then it has to fall again to fill 3. The odds of that happening are much lower than having all 4 of them fall at the same time to the same level and have to pay all 4 options. Does that make sense? I don't have a fancy graphic. I have fingers. Can you count fingers? That's a fancy graphic right there. That is a live visual presentation of vertical diversification versus horizontal diversification. And so what we've just done on this market, Microsoft in particular, we have done a vertical diversification, meaning that we have put our orders vertically, and it's less likely that I'll have all 3 of them hit, as if I put them all right here at this level on 4 different markets. It's more likely all 4 markets would drop and all 4 of my options would get hit. Pretty cool. That's what that is. Okay, and that's what we got going here on Microsoft. So we got quite a little strategy going here on Microsoft. These are all collecting premium. You can see we're going to receive $760, $430, $199. So that's 7, 8, 9, 10, 11, 12, 13, 14, almost $1,400 plus this one up here, which is $1,500, $1,600 if it'll just stay inside of there. Now, it's got to stay inside of there. For how long does it have to stay inside of there, Lan? It's going to have to stay inside of there until it hits that purple line. So this is our gamble here. This is our little bet here. But what I've done here is because I've diversified, if it hits this one, no big deal. Hits this one, no big deal. Hits this one, no big deal. We just buy some Microsoft shares at lower prices. That's all that's saying. It's just saying, hey, I'm going to collect that premium if Microsoft stays above that line and hits the purple line above this red line. But if it goes below that red line, hits the purple line underneath that red line, it just means I'm going to buy some shares of Microsoft. I still get my $760. I still get my $430. I still get my $199. I just have to buy some shares of Microsoft. That's not a bad thing. It's not a bad thing. I could use some shares of Microsoft. It'd be $39,000 for the first one, $38,000 for the second one, and $36,000 for the third one. But hey, nonetheless, I'm just buying some shares of Microsoft. All right. And if it does come down here and we decide, hey, we don't want to buy the shares of Microsoft, which wouldn't be a bad thing to buy some shares of Microsoft at that level anyway. So if we say, well, we don't want to, we just roll it out. We just move it. We sell that one, buy another one, push it out a little bit further in time, and no big deal. No harm, no foul, right? That's how it works. And this one, of course, is a sell up here. So if it goes above there, we're going to sell this one. And if it goes up there, this one's protecting that one. We're going to collect the premium of $265. And then that's our long call. And anything above there, we'll start making money on the long call. How's that? That's pretty cool. And if we don't like that one, we can go ahead and we can roll it out too. We can just roll. Roll, baby, roll. Okay, that's a good one. We like Microsoft. Microsoft's this is a vertical diversification strategy. All right. So we're going to come in here and look at the next one. That was Microsoft, Xylem, CBOE, Snap. But we've already picked a bunch of these. We're going to come into our portfolio. Oh, wait. We took them out, didn't we? Let's run another one. Let's come in here and let's take these off. Oh, we can't take them off. They're in our portfolio. Okay, so let's come in here and let's scan. Well, we'd have to do a scan. That's going to take a long time. I don't want to scan all those. So let's sort them by date, and let's just scan. Let's just scan how many? Let's just scan some of them for the next week. What have we got? What's today? So we're going to scan to the 18th because we can't put anything on. So for the 18th, 15. Oh, well, that's it right there. That's what we did last time. So the 21, those all start at 23. So we're going to remove all these out of the portfolio. I'm just going to remove those, put those all back over into step one. We'll just look at these right here. And these are the ones we already picked. 1, 2, 3, 4, 5. So, well, let's go ahead and calculate that. And why that's running, that's going to take a minute because this is the AI is calculating the probabilities that these things are going to be profitable. So while we're doing that, let's jump back over to the stock market. We'll look some more of these stocks. JP Morgan Chase, we looked at that one. Johnson & Johnson. Johnson & Johnson, we're up $35. We did vertical diversification. So on the vertical diversification, we sold. So how much we make here? Let's come in here to our positions. And we also did the same thing here as we did in Microsoft. But this one, we got a long call, buy a call. So we bought a call and sold a put. So that is a bull call spread. So we bought that, paid $685 for it. We received $195 against the one we sold it. So technically speaking, what we want to have happen here is we want the market to close above that red line. That would be the best thing for us right there. That's what we want. Now, if it just comes up in here, that's not so bad. We'd like it to go above it though, because this is a long call and it's down $150 because it's not exploding quite fast enough for us. It's starting to move in our favor, so it's coming back a little bit, but that's not what it's at right now. So now we've got these options that we sold. And again, since we did diversification, we did vertical diversification, we're going to collect $182, $96, and $58. And then, of course, if Johnson & Johnson falls, ooh, you know what? This is also an X1SA1. X1SA1. What does that mean? X1SA1. Go look in the manual. X1SA1 means that that's a low probability of success to the upside. That's what that means. I always have, that's like a pair of twos. X1S A1. But Lan, last time you said it was an X1S A1. You said actually you changed your mind and decided to call it a C1. Are you going to do that this time? No. This time it really is an X1S A1. I think. Not really. It's an X1S. It's actually, what is this? This is our second drive up. So this is drive 1. This is drive 2. We started to go to drive 3 and it failed right there. You can see it broke the blue lights to the little tiny one. So it failed. So that failed the third drive, and we're getting a pullback here. We're getting a head and shoulders formation. So this is the top of a drive like that. This is a head and shoulders pattern. That's bearish, which makes that X1SA1. But it can't be an X1SA1 at the top. Well, that's a failed third drive, so it is an X1SA1. So that means that should flush and come back down. Johnson & Johnson is giving us a right shoulder on a head and shoulders formation at the top of a second drive and a failed third drive. I'm going to call that a 17. I think you got not a bad hand, but not a great hand. This is not a king and a jack. This is like a 10 and a 7. It's like a king and a 7. Do we want to hit on it or not? I just want to stand on it. All right, because this comes down here like this off that right shoulder and continues that downtrend. We'd be down here buying ourselves some Johnson & Johnson. That's what that's telling us. We'd be buying ourselves some Johnson & Johnson down here. But we want that to rally. We want that right shoulder to come back up. The way we've got this set up, we want that right shoulder to come up here and break the high, which would break the rules. That would break the rules. We want it to turn around and go the other way. But that's a bearish pattern. Well, if it does, we'll still get to collect all of our premium, but we're going to end up buying some shares if it's down here. We're going to end up buying some Johnson & Johnson. And we'll lose the money on that 685 call. That'll end up worthless. But it's starting to rally right now. We just want to see it continue. This is bullish. We want to see it continue. All right, that's where we're at. Let's go back over and see if we're done scanning. Okay, we are. So we ended up with a medium probability, low probability, low probability. But of course, this is still quite a ways out. These are all October 15th, and today is October 11th. So that's 5 days. We have to rescan that. But for right now, we're saying, oh, that's very low. And that's one that's in our portfolio. That's one we picked. It changed its mind because I think that was high before. If we come back over to our portfolio, see, we put that into, but it's now scored as very low. Well, that sucks. Do we want to change up our portfolio? I think we put Xylem. That was one we put into Pit News Magazine too. And now its probability has changed to very low. Does that mean it's going to be very low? Not necessarily. It just says that's what all the indicators are telling us. October 14th to November 28th. And today is the 11th. So not until Monday. But 100% of the time over the last 12 years, 46 calendar days, average profit has been 10%. This thing has actually taken off. October, let's go look at it. Shall we? XYL. Let's do a little self-analysis. We always want to do the self-analysis. Somebody mentioned that to me in the comments. They're like, Lan, you should go look at those charts. Yes, you should. XYL, before you ever put them on. XYL. But you have to look at them before you put them on. That's good and bullish. That looks nice. We're getting a little pop right now. Got a double bottom down here. Xylem. It's trading at $136 a share. It is one. This is in the S&P 500. It's a good stock. It's one of the 500 biggest stocks in the world, in the country, in the U.S. So that is how that works. And we've got a nice little downtrend right here. Little area of resistance. We got another one right here. Kind of breaking that one right now, isn't it? That little kind of went through that wedge pattern. It's trying to break out, go long. Drive 1, drive 2. These are all sideways. It's trying to break. Look at that. It's breaking above the Bollinger Bands. We got the Bollinger Bands coming through with a squeeze out the top. It looks like it wants to go long. It says on Monday it's supposed to go long, but it just said it's not got a high probability. It says it's been very neutral. So it's the AI system saying, well, this thing's been neutral. I don't know if it wants to go or not, but it looks like it wants to go. We could go in early on this one. We could go in today in anticipation of a break higher on Monday above that blue dot. But that would be preempting it. Not supposed to go in until Monday. We could buy a bull call spread with a naked leg. We could do some, let's see what the options are on this thing. Let's go out and see. 35 days out. Oh, that's disappointing. The volume's pretty low. The spread is $20 for a 320. It's 0.6. So not the worst, but not the best. If you were in the real money, you could probably bid for it and get a little bit better price. We got 887 on the open interest. I generally like 1,000. That's 35 days out. The volume is only one. Only one person has traded this thing today. Let's go out a little farther. Let's go out to 98 days. Ugh, it's worse. If we were going to do this one, we can't really do it. It's $13,000 if we were going to do it with our buying power, if we're going to buy some shares and sell a covered call. Or you could just buy some shares. Who wants to do that, though? We like options. But there's nothing there for us. 161 is even worse. 7 days. Nobody traded 7 days today. That 35 days is the only one that's got a possibility, and it's not very good. Not very good for an option. Well, let's not buy an option then. Well, do you want to buy 100 shares and put a covered call on it just for fun? That will use a lot of our buying power. I'm not sure I want to do that. Because then that makes it so we can't do other things that are more fun. You buy 100 shares, it takes $13,000 out of your portfolio. You got to kind of really want to do that. And you want to be able to do that so you can sell some covered calls against it and collect that premium. So it's kind of like a dividend. But can't do that really. I mean, I guess we could. If we were to sell that, where would it be? That's that one. That's that one. We'd collect $162 over 35 days. It's kind of like collecting a dividend if you bought the shares. I don't know. Let's cancel that one. Let's go look at something else. See if there's not another something else. That's Xylem. CBOE. That's another one I think we put in the CDW. Snap-on Tools. This says low. This one says medium. Evergreen. Evergy. October 15th to November 26th. 82% of the time over the last 11 years. This thing's made 4%. That's not a lot. What about this one? But it says it's low probability. Monster Beverages between October 15th and November 29th, 82% of the time over the last 11 years, it's returned 10%. TER has returned 14% between October 15th and November 22nd. 83% of the time. It lost last year. Look at 23. 2023 was a loser. 2013, it was a kind of a zero loss, zero gain. The last 3 years, though, 2020, 2021, 2022 has really been big, but we lost in 2023. Should we go look at Teradyne? Teradyne, T-E-R. T-E-R. Teradyne. Ooh, look at that rotten thing. That would be a beautiful thing for a butterfly, iron condor, iron butterfly. Options. Let's see if there's even. Oh, we can't trade it with options. There's no volume, no open interest. Well, that sucks. Sell some puts. Oh, look, people are selling puts against it. You could do look at this. Here's something we could do. I don't know if we want to, but we could. We could, even though we might not want to, but we could. Let's go look. Between October 15th, 12, 13, 14, 15, which is middle of next week, to November 22nd, which is middle of next month, 83% of the time over the last 12 years, this thing's risen in price. Is it bullish? Yeah, bullish. 14%. That's big. That's big moves. Semiconductor. Well, how do we make money off of that? It's not rising, but the chances of it falling are pretty slim. Not that it can't, certainly can. Right? So here is the situation that we have. Here is the situation that we have. There is some volume and open interest on there's no volume. Look, no volume. But there is some open interest out here. And the spread is not that bad. It's 0.6, which is what we're finding on almost everything right now. It's $15 on a $262 premium. We could sacrifice $15 for a $260 premium with something that's got like an 81% chance of being paid off. We could do some vertical trades in here, vertical diversification. You want to do that? Let's do that. 35 days. We're going to come down here. We're going to sell a put. Let's see. Well, maybe not. Depends on how far away we can get. Well, that would be a good one. We'll put that there. What's the chances of the market falling all the way down there? Well, let's look at the odds. Let's look at the odds. That's just saying I'm going to buy some Teradyne shares at that price. That's all it's saying. And if it doesn't fall down there and give me my Teradyne shares, they're going to give me $170. Okay, I'll take the consolation prize. So that's saying it's got to close, got to hit the purple line underneath the red line. If it does that, I'm going to buy 100 shares of Teradyne stock, which would be a good price for it anyway. That's good. That wouldn't be bad. And especially where the seasonals are saying generally this thing rises over the next month anyway. Receive $170. And we could come down here and say, well, look at this. I could do some vertical. I could sell another, not a call, sell a put. I could do another one. I could do one up here, right there underneath that area of support. That'd be $385 that they'd give me. But if it fell below that red line and touched the purple line, I would have to buy some Teradyne shares. I could even sell a third one, sell a put down here, and collect $70 if it came all the way down there. Now, what's the odds on these? Your probability of being out of the money on this one is 74%. So your odds of winning on this one, 74% chance of being 74% chance that you're not going to have to pay your shares. 74% chance that you're going to get your $385. This one here, if we sell, we'd collect $170, and we have an 86% chance that we are going to collect our consolation prize and not have to buy the shares. This one here, $70, has a 94% chance that that's going to give you the consolation prize of $70, and you're not going to have to buy any shares. That's what that's telling you. That's the cone of probability. What, Lan? What's the cone of probability? You guys, come on. How many times do I have to tell you about the cone of probability? I tell you about the cone of probability every single day. But we do have new guys, so let's tell them about the cone of probability. The cone of probability is what we trade off of, all right? This is the cone of probability. It's called the calculating the delta cone of probability. Now, if you want to go out to ChatGPT and ask it what the cone of probability is, you're going to want to put in this word right here, the 68-95-99.7 empirical data distribution rule. Ask ChatGPT what that is. And what it's going to do is it's going to tell you about this cone of probability, where the market has a tendency to like to stay inside the major size of the cone right there. 68.2% of the time, the market likes to stay in there. Okay. And then 95% of the time, which the opposite of that is what, 5% of the time the market likes to leave that cone. And then less than that, like 0.3% of the time, the market wants to go outside that cone. So it stays inside of that cone 95.4% of the time, the 2 standard deviations. It stays inside the 1 standard deviation 68.2% of the time. All right. So that is what's powerful about the cone of probability. And that's what we're trading whenever we look at options. We're looking at how far outside the cone of probability. So the delta cone of probability, if you wanted to see it visually, would look something like this. Right. And so that would be the direct center. And then you get your variations out here a little farther. And the further outside the cone you go, the less likely it is for the market to actually get all the way down there, way out into this further regions of the cone. So that's why they don't give you as much money. They only give you $70 because the chances of it going out there is pretty slim. They don't want to give you a whole lot of money. But there is a chance it could come to this one, which is why they'll give you more money, $385 to come to this one, all right, because it's closer inside the cone. But the cone, the delta cone, is right here, and we anticipate the market rising anyway, going this direction. So chances of it coming down this direction is actually pretty low. So there you go. If you sell this premium here, you get to collect 385, 172, and 70, and you're vertically diversified. Now, the question is, do we want to do it? We're going to receive $625 for doing it, which would be a return on our risk of 10%, 10.55%. That's pretty good, 10%. Most people will wait 2 years to get 10% return on their money. We're going to get 10% return on our money, which is our margin requirement of $5,922. We're going to get that in 35 days. That's your leverage when trading options. That's pretty cool, right, guys? You got to admit. Now, the question is, do you really want to do it? You're going to have to pay a little bit of, you're going to pay 30, 40, 50, about $55 in spread to get into this thing. Now, if you're in the real money, this is the demo, and the demo doesn't let you bid. All right. But if you're in the real money account, if we wanted to put this on in our real money account, we could bid for it and we would actually we could get better than that spread. I think we could get a little bit better. They'll give us a little bit better price if you bid for it. It's like a pig auction, right? You have to go to the pig auction. Those of you who haven't heard me talk about auctions, the bid and the ask, every time you buy and sell options, you're going to an auction, just like the pigs, a pig auction. And you bid for them, all right? And you can bid it down a little bit and get a little bit better price. But right now, they're telling us that we're going to have to pay $30, $40, $55. You can see right there on the spread. Now, there's no commissions, not in Track and Trade. Now, I don't know what platform you're using or what brokerage firm you're using, but Track and Trade connects to a brokerage firm that doesn't have any commissions on options, but they do have the spread, just like every other brokerage firm. They all have spreads, but this one has no commission. So you don't have to worry about commissions, at least. The stocks version. Now, in the futures version, you still have to pay commissions. But that's what you would receive. You receive $625. Return on risk would be 10.55%. The margin requirement would be $5,922 if we wanted to do that. Now, if it come down here and started to move against us, let's say it comes down here, and it comes down and it looks like it's going to hit down in here, we're getting worried. We could roll this out. If you don't want to buy the Teradyne shares, you just take this one and you roll it down here, right? You just roll it out and you pay a little bit more for it, or actually you probably receive a little bit more, but you roll it out in time. So you get more time. You have to wait longer to get your money. And then it's less likely that the Teradyne's going to keep going down there. And so then you wouldn't have to buy the shares if you didn't want to buy the shares. If you don't mind buying the shares, then buy the shares. By all means, buy the shares and then sell a call against it and start collecting premium that way, just like we did on the other one. All right. That's called the will strategy for those of you who want to know the actual terminology of what that strategy would be. All right. Let's go ahead and we're going to mark it into that and see if it'll let us have those. Where did it go? It threw our order out, probably because I waited too long. It expired. Okay, let's come back in here. We have to place it again because we sat here and waited too long before we placed the order. So it expired. Okay, our ticket expired before we placed the order. So let's come in here. We'll just do it real fast again. We're going to drop this in here. This one was first. This one was second. And then this one was third. This one was at $70, right? 70, okay, 630, that's what we had. Okay, we're going to mark it into the, we're going to mark it low. Let's do this with a limit order. So net credit, they're asking, we're going to go the other way. We have to go to the bid. So we're going to go to the bid 610. Ugh, that's where it's going to go all the way down here, and we're going to have to pay 610. Let's hurry before we expire again. Did it work? Yep, give us all three. Boom, there we go. We got our options. Okay, now we just want Teradyne to go up. Like I said, it's going to do in the seasonal nature of markets. All right, so it said it's going to go up. So we just put, now we're not long. We didn't buy a call, because if the market doesn't burst and go fast and hard, call options don't make money. They need to have a fast rising market. This didn't look like it was going to, I mean, from looking at it, it doesn't look very fast rising to me, right? So we just want it to slow rise. We just don't want it to go down. Just slow rise is fine, or go sideways. We don't care. We just want it to hit that purple line above that red line. That's all we're trying to do. No big deal. We just want it to hit that purple line above the red line. We collect our full $600 and make our 10% return. It's like collecting money. It's like getting a dividend. So we'll get our dividend in 35 days. We get all that money no matter what. We get all that money. That's our money no matter what happens to this. We get all that money. That's ours. We just made it. It's ours. It's ours. Everything there is ours. As long as we don't sell it. Now it's going to show you right here a loss. See that? It says right here, minus $10, minus $7, minus $5. The reason we're down is because of the spread, right? We had to pay the spread. But it shows a loss. Now remember, those numbers do not pertain to you unless you decide to bail out early. If you decide to liquidate these positions before that purple line, that's when those numbers apply to you. Okay? Otherwise, those numbers do not apply to you. They do not apply to you. So don't get all nervous and scared and worried. Oh my gosh, my position is losing money. Your position is not losing money unless you execute it. All right? Unless you actually liquidate the position before the purple line. If you wait till the purple line, no matter what that market does, you're going to get this money over here, 380, 165, 65. You get that, yours. You never have to give it back unless you bail out before the purple line. If you bail out before the purple line, the numbers inside that box, then they pertain to you. So you get to only worry about these numbers here if you're going to keep it till this number. Now, at that point, you have to come over here and worry about what's going to happen over here. Okay? So what you're going to do is you're going to worry about what happens over here. And then you're going to have to ask yourself, do I want to bail out? No, you don't want to bail out, because you've already decided that you're going to own Teradyne. If it comes down here and touches right there, you're going to own 100 shares of Teradyne. Or if it comes down and touches below this red line, you're going to own 200 shares of Teradyne. And if it comes down here, you're going to own 300 shares of Teradyne, which is not a bad thing. That's not a bad price to be buying Teradyne at anyway. You're going to have 3 shares. Then you're going to start selling calls against your 300 shares, and you'll just make it all back, and then the market will turn and go back up, and you'll make money anyway. Okay, just take longer. So that's the way that game works. Don't get all nervous and upset about these numbers right here, because they do not pertain to you unless you decide to bail out before the purple line. Okay, that's how it works. Anything else we want to say over here? We put Teradyne into our portfolio, so we got to click on that one. And we put Xyla. That one's already in our. So we're going to add Teradyne to our list. So let's come over here to the portfolio. We've got Teradyne in up here, and we're going to take that, and we're going to add it to our portfolio. How do we add it? Add to trade alerts, add to print, remove, move to portfolio. So I moved Teradyne in there just because we've got those options on it. So I put it down here in our portfolio, and that's where we're sitting right now with our portfolio in TradeMiner, and that's how we did the trades in TradeMiner. All right, there you go, guys. That's having fun with options in Track and Trade. And if you would like a copy of the software that I'm using, because it is pretty cool software, there you go. Go to trackandtrade.com, 7-time Stocks and Commodities Annual Reader's Choice Award-winning platform. We're using the stocks version for today, or we're playing with the futures version over there this morning, earlier. But we're just using Track and Trade software. So there you go. And don't forget to get your Pit News magazine over at pitnews.com. And guys, don't forget to like and share and subscribe. If you haven't liked, shared, and subscribed, do that. Do that now. Let's say Rock's asking a question. Let's go answer some questions, see what guys have to say. Yes, got to have Pit News magazine. Kirk, always thumbs up on that Pit News magazine. So what's Rock saying here? He says, if you were going to trade the stocks in TradeMiner with real money, would you use TradeMiner as a setup and wait for a trigger, or would you just arbitrarily take the top best stocks? The way I use it is just how I just did it. So what I do is I just use it as a guide of stocks that I should look at. I want to look at the highest probability stocks, the ones that are giving us the best seasonal nature. Then I bring those over into track and trade, and then I look at them and decide if there's something I want to do in agreement with what's going on over there. I don't ever trade just flat out seasonals. A lot of guys do. It's very popular, and I didn't make this up. I mean, this is something. I'll give you a little history of where this software came from. Have any of you guys ever heard of Simplot? Some of you guys from Idaho or up here in Utah, out here in the West, you've probably heard of Simplot. Simplot is a massive company, great big huge commodities company, and kind of like ADM. You guys, many of you have probably heard of ADM. ADM, Simplot, same type of thing. Great big huge company out here in the West for commodities. And I had a buddy, his name was Scott Berry. Some of you guys might even know him or know of him. He's not with us anymore. He went swimming in the river and drowned. One of my best friends, and kind of feel bad about that. But nonetheless, he and I were working on this project together. He worked as a subcontractor for Simplot, and he worked as an analyst in their futures department to help them know all this seasonal stuff so that they could do seasonal trading with all of their products. And that's what his job was. He would advise them. And then he came to me because I owned a software engineering firm, and he said, can you write me a software program that I can use so I don't have to do this all in Microsoft Excel, and then I can do all this work for Simplot, and I can advise them on where they should be using their buying and selling their commodities. And so we created a futures version, which we have a futures version. Today we were using the stocks version, and he was using that, and we had an agreement. I said, well, you know what? You are a fantastic advisor, and I would love to have you on my team, but I can't afford you. You want me to write some software for you, I'll trade you your time to advise me and my company to make sure I'm doing everything right as a compliance officer, and that I'm got somebody I can go to as a go-to guy to ask all these advanced questions to. And I will write you that software at my expense. And he said, deal. So we shook hands. It was a handshake deal. And that was what we did. He never owned the software that I wrote. I owned the software because I wrote it. But he worked for me to be able to use it and use it in Simplot. And he tied me up so that I couldn't sell it. I couldn't share it. I couldn't show it to anybody. It was proprietary. So he was the only one who was allowed to use it, even though he didn't own it. But he tied it up so I couldn't sell it. I couldn't share it. I could use it myself, and I did. You know, that's how we traded. We would we'd do just that. We'd go in, we'd look at the seasonal nature of the markets, and we would decide what we were going to buy or sell based on its, and then, you decide whether you want to take the advice from the seasonal nature of the markets. But that's what happened. And then he went swimming in a river and drowned. And so then it left me with the software, and Simplot didn't want to have anything to do with me. They didn't know me from Adam. So I couldn't go in and take over that job. Not that I wanted to. I didn't want to work for Simplot. And so now I have this really cool little piece of software that we'd been using for 10 years. 10 years as a proprietary secret little piece of software that I wasn't allowed to tell anybody about. I wasn't allowed to show anybody. I wasn't allowed to tell anybody. I wasn't allowed to, it was just an internal piece of software that we had. So we decided, well, let's put a graphical user interface, a retail client user interface on the front of it. Because before it was kind of an ugly program that he used. And so we said, well, let's make it really user-friendly and easy. And then we hired another guy that came in and said, well, let's put AI into it. So we put AI into it. So it's got artificial intelligence built in there, a neural network built into it to help us determine, some of the after the market stuff. So that's how we end up with TradeMiner. We kind of inherited it in a way. I mean, I wasn't allowed to sell it while he was using it, but when he expired, it became mine. And so then I decided to sell it. And that's how we got it. So there you go. It's an old Simplot program that was used to help them manage all of their trades. And they used it religiously for 10 years. And I don't know what they do now. That guy's not with them anymore. So, and here you go. And I do know that we have sold it. There's a copy in a multi-billion-dollar hedge fund company right now out in New York that owns it and uses it for their trading. So can't tell you their name, not allowed. but there is one. I know of one, maybe more, because we don't, you know who buys it. You get a name, but that's all you know. You don't know what they're using it for. But we do know one is a multi-billion-dollar hedge fund uses it. So that's where TradeMiner came from, Mr. Rocksteiner. So that's how I use it. So I just use it to give me a guide of things to look at. And then because I'm a technical analyst, I'm going to analyze it from a technical standpoint. And then we're going to see where the best opportunities are using the seasonal nature of markets to kind of give us an idea of what we should be looking at. Do I take it as a seasonal, just a hardcore, hey, it says to buy on this date and sell on that date? No, I don't do that. Yeah, Kirk has TradeMiner. Do you like it? You found much use in it, Kirk? Has it helped you skinny down your list of things to buy, things to look at? I just look at the S&P 500 in there. I don't venture out much beyond the S&P 500. I'm really an S&P 500 trader. I figure if it's in the S&P 500, that's a stock I trust. I'll trade it. I'm not, you get off on some of these weird stocks, the meme stocks and stuff like that, and guys get excited and you hear them about them. If it's not in the S&P, I generally don't pay much attention to the stocks because usually you can't get options on them, and I like to trade options. And I don't know. I just kind of like the S&P. I like the warm fuzzy of those big stocks. So Kirk's saying I use it the same. Look at the trades before I take a position. Yeah, that's how I use it. I don't just go in there and say, well, Microsoft's supposed to be bullish during this time frame. It has been for the last 15 years. Might as well buy it. I don't do that. I go in and look at the patterns and see what it's doing and try and work out a strategy based on that knowledge. And it works good for me. What we're doing in this class, though, is we're just following through and just following it. We're just putting them into the portfolio just to see if they pan out, if they actually did what they said they were going to do this year. So that's what this portfolio is all about. So if we come into accounting, you can see these are all that just followed through straight through with just buy on this day, sell on that day. And it's not what we did in our own portfolio and how we traded these ourselves. This is just following through, letting the system choose them, bring them through, going through the whole process and kicking them out the back end and see how we do. That's what we're doing here. And it's fun. We like doing that. Is that how you're going to trade them? Probably not. But at least to let you know that, hey, seasonally speaking, the markets are on track during this month. They have been. This month they were not. September, October, these in here, this August 22, 23, 24, they've not been. We had 3 losers in there. So, that's the way the cookie crumbles. We're down 2 right here at 340, 112. This is not doing what we wanted. So anyway, all right, guys, I've talked your ear off. Don't forget to like, share, and subscribe. If you have a comment, leave it in the comments. That's always good. Like to have the comments. And again, tonight, Friday night, is the university class. For those of you who are members of the university, we'll see you tonight. And for the rest of you, we'll see you Monday morning, bright and early, 7:30, Monday morning. Be there, be square.